So as you started investing as a founder, also a pretty typical thing these days with successful founders that have crossed certain aspects of their journey. What's the framework that you use in order to make investments? Because certainly I would say that a founder, this is my perspective as a founder as well as an entrepreneur, but as a VC, is that oftentimes founders that invest, they're also really interested in supporting that individual, and to a degree they have some sort of intellectual overlap in that area or field where they believe that that's a big need for that market. They're almost as if you start your journey solving a problem for yourself that you wish you could, you were pretty upset about, and then ultimately you then building leverage on, hey, I actually want more problems solved for myself, so continue to make these investments. So what is your framework basically for
I
investing?
would say there are two things that I am not necessarily the guy who really needs to be hands on and very close. I would say I'm more of a low touch investor. I often pick one specific company that has one specific problem that I can help to help. But most of the time, I'm pretty hands off on that. And what I look for when doing business, I would say just three things beyond the team. Like if I don't like the team, I will not do it. But if I like, doesn't mean that I will do it. I would say the first is sounding economics. So I typically look for companies that have 10, 20, 50, 100 customers. It's very rare for me to sign a check on the zero customer or the PowerPoint stage because I like to believe that I'm good at pattern recognition on economics. And the thesis might fail, but ultimately, when it comes to SaaS, which is the area I focus the most, all business are equal. It changes the size of the customer acquisition model, the stickiness of the product, but the core system for a SaaS business, it's very easy to spot the patterns. I would say that the next two, they are pretty weird. Low risk and I like low risk. I think most business are, when it comes to SaaS, they cannot be huge. Like, oh, this company, and I would say this is one of the pillars of my Brazil angel investing strategy. CRM for small business in Brazil. That's not a unicorn, but it can easily become a 100 million companies. The market is huge. So I'm really not optimizing for unicorns when I do Latin America. I'm reducing risk. Worst case scenario, came in early, we'll have decent secondary in a B round or something like that. When it comes to the third one, it sort of conflicts a little bit with the second one, but it's the size of the opportunity. And I prefer to take a lower risk and a lower opportunity size. But when I want to take a big risk, the message market has to be huge. And these are the kinds of bets I take mostly on US based companies or companies that are primarily focused on the US market. That's my hedge, but most of my investments to date, they've been in predictable economics, low risk. Um, the US, typically, they are predictable economics. Still, I would say they're pretty much low risk.
That's great. Yeah, I mean, what you're there's a lot of fascinating aspects of what you're talking about, specifically for what we do at Atman and as a cross-border investor. The I'll give you an example of a company that you angel invested. and something that I said that I ended up not doing, and you made money on it, was Terravos, right? It's the typical company that I mean, in my mind, I was like, oh, it only works if Twilio buys it. And I was like, exactly,
They did it.
exactly what happened. But that aspect of investing that you're talking about, where the number one thing I look for, even before people and product, is a market. It's always the TAM, and the market needs to be super super large. So then the outcome is very large. So I typically, specifically when even talking about investing in Latin America, try to look for the Rappies, the Loggies. I did invest in both of those, but didn't invest in Nubank, for instance, right? But it's a great barrier that it's a $35 billion company today in LATAM. We will over time continue to have more and more of those. So I can see a strategy as an angel for a bunch of investments of companies that would be sold for sub 100 million USD. And that could be a massively successful fund, specifically also, I guess, with all the connections that I have in the US, but just to sell these things quickly. Meaning it would have to be mostly first-time founders that want to have their first liquidity event and are all kind of like in the zone of like, we know that whenever we get this offer, we'll sell it. You can get a lot of ownership in the beginning, and typically this lower risk, better sound economical model works. Then it works less when you want to try to raise money from U.S. investors, which is also something that as a VC, it's a big value add I provide. Because for them, an exit outcome, for instance, of a Terravox doesn't move the needle because of the size of their funds. It doesn't mean that it's a bad thing. It's just how the business works. So I love your Brazilian strategy as an angel. I respect it. I think it's a very profitable one. I just haven't pursued it at the institutional level because I think that it just
No, I
yeah.
agree. It's not a good fit for a professional fund. Like if you're, I don't know the size of the vehicle to justify, but this strategy has a very clear cap. What I'm playing is on the inefficiency of the first check, that it's very rare and gives you a lot of opportunity to come in at a very reasonable price, and the increased liquidity that are happening on the middle stages, because I tend to be hands off. So one example of a company that I would say, I think we're a market, let's say 50x there. It's a huge market, local. It's a almost zero risk business, very sound economics. And I think this is my best deal in Brazil to date. And it's a deal we invested 1.5 years ago.
What's the
In
company?
the Oh, I can't disclose this,
Okay.
fortunately.
No problem. No problem.
Um, when it comes to when you're doing small checks like 5K to 100K, you don't always need to be looking for the unicorn, and you don't always need to follow a very structured playbook. You can be more opportunistic. One example for me that made a lot of sense. This is part of my US portfolio. I think 2 years ago, I bought secondary shares at Palantir at $6 a share. Small check, but very meaningful return right now with their IPO. It's 6x in 2 years. It's pretty decent.
Yeah, it's
So I
awesome.
don't see it as if I were doing a large fund, very likely my strategy wouldn't be the best. I think because I'm doing very small checks, it's been pretty successful to
Yeah.
date.
No, both work. That's why I think that there is, and it's important to align what's the level of economical outcome that the founders also are procuring. That's also something that I learned that as I started having exits that were earlier than what I wanted. I was like, no, like, and then, but you always have to be in that particular situation founder friendly, and respect that the founder just they just want that at the personal level, but knowing how to. Fortunately, I learned these lessons making money for my investors, but uh, these were companies that had multi-billion-dollar potentials, and they were being sold for 20, 30, 50 million, and um, um, that's why I always want to know these motivations where you're talking about books and guitars and how much money you have in the bank account, and you can judge other people, but I think you need to partner with the ones that are in for the long ride, knowing that you can have pit stops with secondaries in the middle of the way to then continue to go along.
Yeah, I
You
would
know.
say that in specifically in Latin America, there's still a huge opportunity at the first on the angel and seed and even on the Series A area. There's still not a super proven market for exits, etc. In with one advantage, you will never have paid too expensive on the valuation you did, like unless the company is already scaling abroad or I mean, you can never have paid expensive by investing in Nubank, for instance. And I think that's something we see. Maybe at the time it's looked very expensive, but the market is huge. The access to capital is still limited, so
Yeah, and
it's
even
low
the
risk.
it's lower. Yeah, and then even the quality of the capital also, I would say that there's one thing that, like, talking about the MUT complex, so complexo when I started in venture, I, I I was scared. I was basically, can I be successful? I'm in the Bay Area now. I'm an associate at a firm, and I started interacting with people and interacting with other VCs, and I saw that, oh, there's a reason why Sequoia Greylock and Benchmark and Excel, like, they're still at the top. It's because they are the only ones that actually work very hard. And now you have this new entrance, right, with Kochu and Tiger and D1, and they also are very smart and work very hard. Um, but the majority of investors are parasites. They're just super fucking lazy rich people. They don't work, and that's the majority. And I think that's something that when I saw that in the Bay Area and also in Latin America, I got excited because I was like, oh, I have a chance to be a leader in this industry. As long as I have determination, hard work, and some luck, it's gonna be okay.